Net present value shows up a lot on the CPA exams. So in this video, I'm going to give you a basic intro into net present value, and then we're going to look at 3 practice questions, 2 moderate level questions and 1 difficult level question. So the idea behind net present value is we're considering an investment option, and we're going to look at all of the cash flows from the investment option, but we need to find the present value of the cash flows. So then we subtract the initial investment from the present value of the cash flows. And if the net present value is positive, we accept the investment decision because we would actually make money. And if it's negative, we would reject the decision. Sometimes a question is going to have even cash flows to where it says you receive $20,000 for 4 years. So that would simply be an ordinary annuity that you would use. And then other times you're going to have uneven cash flows each year. So in that case, you have to actually go to each year and use the lump sum formula to find the present value and then add up all of the present values of the cash flows. And then in the more difficult net present value calculations, you're going to have the depreciation tax shield. So because of depreciation expense, your taxable income decreases, meaning that you have to pay less in taxes. So this is considered as a cash inflow. So for example, if we have $10,000 of depreciation expense and a 20% tax rate, this means that we're now paying $2,000 less in taxes because of the depreciation expense. So this $2,000 is the depreciation tax shield, and then we'd find the present value of the $2,000 to see how it affects the net present value. Another complicating factor is when you have a salvage value at the end of the asset's useful life. So if you're going to receive $20,000 for selling the asset at the end of its life, this is considered a lump sum. So you'd calculate the lump sum based on the end of the asset's life. So these are the basics of net present value. Now we're going to go through the 2 moderate level difficulty questions. The first one has even cash flows. The next one has uneven cash flows. And then the third question is going to have depreciation tax shield and the salvage value to calculate. So let's jump in.
So let's take a look at this first NPV question. It's more of a moderate level difficulty question, pretty standard for what you could see on the exam. So we start with the last sentence first. Based on the following table, what decision should Greenhill make concerning the acquisition of the equipment and why? Greenhill Corp, a non-profit organization, is considering purchasing a piece of equipment for $120,000. So that's the cash outflow. That will generate consistent cash inflows of $40,000 for 5 years. Greenhill assesses capital projects using discounted cash flows at a cost of capital of 8% per year. So we know that $120,000 is the initial investment. We don't have to find its present value because we're spending it today, so $120,000 is the present value. But we do need to find the present value of this $40,000 ordinary annuity for 5 years. So the future value of $1 is irrelevant. Also, the present value of $1 is irrelevant because we're not trying to calculate anything for the lump sum. We just have this ordinary annuity. So we're not focused on this either. And we don't need to calculate anything future value for an ordinary annuity. So we're just focused on the present value of $1 ordinary annuity for 5 years at 8%, 3.993. So we just simply multiply 40,000 times 3.993. That's the present value of the cash inflows, 159,720. And then we subtract out the initial investment of 120,000. So then the net present value is 39,720. So it's positive, so then we're going to acquire this equipment. Now let's take a look at this net present value calculation when we don't have the same cash inflows every year. So we have uneven cash flows for years 1 through 5. So instead of using an ordinary annuity factor, we have to use the lump sum factor for each individual year. Forest Edge, a nonprofit organization, is contemplating investing in a project that has an upfront cost of $90,000. The project is projected to generate uneven cash inflows over a period of 5 years. So then we're going to use each of these individual lump sum calculations. Forest Edge uses a discount rate of 7% per year for evaluating capital projects. Based on the information provided, determine if Forest Edge should invest in this project. So it's simply going to be 30,000 times 0.35, 25,000 times 0.873, 20,000 times 0.816, 15,000 times 0.763, and then 10,000 times 0.712. So then that brings you to the present value of all of the future cash flows, and then you just subtract out your initial investment of 90,000. So we then have a negative net present value of 5,240. So since it's negative, we do not invest in this project. Now, if you wanted to manually calculate the present value here instead of using the factors, what you have to do is divide the undiscounted amount by 1 plus the discount rate, and then it's to the power of however many years have passed. So for the first year, just 1 year has passed, so it'd be 30,000 divided by 1.07 to the power of 1. And then for the second year, you'd have 25,000 divided by 1.07 to the second power. So this gives you a tool just for manually double checking your answers and for becoming more comfortable with present value calculations. So you could do all of these here and then add them all up, and it gives you a very similar answer. The only reason it's different is just because these factors here are just slightly rounded. So those first two practice questions were moderate level difficulty, and they really just involved calculating the present value of the cash inflows. This question is going to be a difficult level. It's going to involve the residual value of an asset, and it's also going to involve the depreciation tax shield. So there are multiple things going on here. Based on the following table, what is the net present value of the water treatment system? Clearwater, a nonprofit organization, is considering purchasing a water treatment system for $250,000, so that's the outflow, that will produce uniform cash inflows of $90,000 for 5 years. So that part will be pretty straightforward, $90,000 ordinary annuity. The system has an expected useful life of 5 years and a residual value of $25,000. Clearwater uses straight line depreciation and has a 30% tax rate. So what that tells us is that the company is going to have a depreciable base of $250,000 minus the salvage value, aka residual value, of $25,000. So each year it's going to be depreciating $45,000. So the question is, how much of a depreciation tax shield does that create? So this decreases our taxable income by $45,000, and that means that we're going to be paying $13,500 less in taxes. So because our taxable income is $45,000 lower and it's 30% rate, that means that we're paying this much less in taxes. So we treat this like a cash inflow. So the fact that we're saving this money is treated as a cash inflow. And we're going to have to then find the present value of that depreciation tax shield. So then the annual inflows each year are going to be the $90,000 plus the depreciation tax shield of $13,500. So we have an undiscounted amount of $103,500. So then we're going to multiply this by the present value of $1 ordinary annuity for 5 years at 12%, 3.605. So that brings us to $373,167.50. So then we're almost done, but we have one more cash inflow that we need to find the present value for. So at the very end of this expected useful life, we're going to have a residual value of $25,000. We're going to sell this asset for $25,000. But that's the undiscounted amount. We have to figure out how much that $25,000 is worth in today's dollars. So we're going to use the lump sum formula here to calculate the worth of that salvage value. So we take the $25,000 salvage value times 0.567, and that brings us present value of $14,175. So then we're going to add that to this $373,000. So here we get the total present value of the cash inflows, and then subtract out the initial investment of $250,000. So that brings us to a net present value of $137,342.50.
So I hope that you've learned a lot by going through these 3 practice questions. Be sure to check out some of my additional CPA videos to keep preparing for your exams. Thanks.